How can a startup, a company that hasn't made a single dollar of profit, somehow be worth billions of dollars? It's a wild world of hype, potential, and some seriously big numbers. Kind of insane, right?
Okay, just to set the stage, look at this. It shows just how crazy things got. Back in 2013, a unicorn, that's a startup worth over $1 billion, was, a pretty rare thing. We saw 4 of them. But fast forward to 2021, we were seeing almost 2 new unicorns every single day. It was a total explosion. And yeah, that boom brings us right to the heart of the mystery we're going to unpack today. How does this even work? Where does this billion-dollar math come from when there are literally no earnings to count? It just doesn't seem to add up. To solve this, we've got to get our terms straight first. It really all starts with understanding the massive difference between what something is actually worth and what someone thinks it might be worth down the road. This slide has a perfect way to think about it. Value is simple. It's concrete. A $1 bill has a value of, well, $1. But a valuation? That's a completely different beast. It's a forecast. It's a story about the future. A super rare collectible dollar bill might have a valuation of 150 grand, all based on what a buyer believes it's worth. And that second bucket? That's exactly where startups live. Now, for normal, established companies, the ones that actually make money, investors have a standard formula called the price-to-earnings, or PE ratio. It basically asks, how many dollars are you willing to pay today for $1 of that company's profit? But get this, what this timeline shows is that even that so-called standard formula is all over the map. Back in the 80s, investors would pay about $8 for a dollar of profit. By 2009, that shot up to $70. Today, it's kind of settled down around 21. So it just goes to show you, even for profitable companies, valuation is super fickle and really depends on the economic vibe at the time. So this brings us to literally the billion-dollar question. What happens when the E, the earnings, in that PE ratio is 0 or even negative? How in the world do you put a price tag on a company that hasn't made any money yet? Right, so if you can't value a company based on its profits, what's left? This is where the whole thing shifts from reality to a really, really compelling dream. It's not about what the company is, it's about what it could become. Here's a great way to wrap your head around it. Imagine you run a normal hotel. Your income is capped by your number of rooms. Simple. But now, what if you built a digital hotel? Think Uber or Snapchat, with basically an infinite number of rooms. And what if you already had hundreds of millions of people staying there, using it for free? The pitch to investors becomes pretty simple. Look at all these people. Just imagine how much money we'll make once we figure out how to charge them. And the way they sell this dream is with something called vanity metrics. These are the big, flashy numbers that sound amazing. Millions of users, billions of views, tons of downloads. But they have no direct connection to revenue or, and this is the important part, profit. And for a really long time, this strategy worked like a charm. Why? Because of one really powerful human emotion, FOMO, the fear of missing out. Investors saw these huge user numbers and were absolutely terrified of being the person who passed on the next huge, world-changing company. Just look at Uber's early days. In 2011, it was worth a solid $60 million. But just 3 years later, by getting investors totally focused on the vanity metric of rides per day, its valuation exploded to $41 billion. Let that sink in. Its value grew by about $30 million every single day for 3 years, almost entirely based on growth, not profit. And it's not just Uber. Snapchat is another perfect case study. It has this huge, super engaged user base, and it's valued in the billions. The only catch? It has never, not even once, actually turned a profit for a full year. This just perfectly captures that huge gap between user hype and financial reality. Okay, so this hype-fueled rocket can't just fly up forever, right? Sooner or later, the promise has to meet reality. And when that happens, well, it can get ugly fast. And listen, this is not a new thing. We have seen this movie before. Let's rewind to the dot-com bubble. There is a grocery delivery company called Webvan. It was making less than $500,000 in revenue, but it went public with a valuation of $4.8 billion. That is 12,000 times its revenue. And yeah, you can probably guess what happened next. It went bankrupt. And we've seen this exact same story play out again and again recently with some really big names. WeWork's IPO got yanked when investors finally realized its $48 billion valuation was just pure fantasy. FTX's $15 billion valuation disappeared, poof, overnight. Meta lost 74% of its value in 1 year, betting the farm on the metaverse. Eventually, the hype always hits a brick wall. So because of all these very public flameouts, plus a much shakier global economy, the whole investment world is changing. It really feels like the party is over. Of course, the venture capital firms, they don't call it a crash. No. The fancy term they're using is a market readjustment, which is basically a polite way of saying they're sobering up and realizing that the old model of just burning cash forever in search of growth, well, it just doesn't work anymore. And readjustment is a pretty gentle word for this. Look at that number. Startup sales and IPOs, which are the main ways investors actually get paid, have dropped by a mind-blowing 88%. The exit door has basically been slammed shut. You know what's serious when one of the biggest, most famous venture capital firms in the world, Sequoia Capital, sends out a memo to all its companies that's basically a giant warning flare. The message was blunt. The good times are over, save your cash, cut your spending. Now. So what's the big takeaway here? It's that the rules of the game have totally changed. Investors aren't buying those vanity metrics and vague promises anymore. They want to see the real numbers. They want provable revenue, solid financials, and a clear, believable plan to get to actual profit. Which leaves us all with one final, really interesting question for the future. As we head into this new, more careful era of investing, have we finally hit a turning point? In the hunt for the next billion-dollar company, will real, boring, sustainable profit finally matter more than a really good story? We'll have to wait and see. Thanks for watching.